Your wallet didn't shrink, your dollar did. And right now, as you watch this, a financial earthquake is happening that most people have absolutely no idea is unfolding beneath their feet. What I'm about to show you is not a conspiracy theory. It is documented, data-backed, and happening right now. Welcome back to Money Science AR, the channel where we break down real economics in a way they never taught you in school. If you're new here, do yourself a favor. Hit that like button right now, smash subscribe, and share this video with anyone you know who works hard for their money, because what you're about to learn could literally change how you protect it. Let's get into it. Here's what happened. In plain language, in 2025, the US dollar had its worst annual performance since 2017, falling over 9%. That might sound small to you. Let me put it into real-world terms. If you had $100,000 sitting in a savings account earning almost nothing, you effectively lost $9,000 in purchasing power, not because you did anything wrong, not because the economy technically collapsed, but because the dollar itself got weaker. And it wasn't just a minor dip. The dollar index, which measures the greenback against a basket of major trading partner currencies, fell about 11% from January through the end of June 2025 alone. That was the biggest decline in more than 50 years, ending a 15-year bull cycle for the dollar. 50 years, let that sink in. After rising to a multi-decade high in January 2025, the dollar declined leading up to and then following the tariff announcements of that year. Now here's where it gets really uncomfortable. Morgan Stanley research estimates the US currency could lose another 10% by the end of 2026. We're not talking about some fringe economist on the internet. We're talking about one of the most powerful financial institutions on the planet. And ING, another global financial giant, published this just in February 2026. Their baseline view for the dollar is a bearish one for the remainder of 2026. With the concentration of risks in the U.S., from equity valuations to fiscal and political risks ahead of the midterm elections, meaning the risks remain on the downside for the greenback. So the question is not, is the dollar weakening? It clearly is. The real question is, why and what do you do about it? The 5 real reasons the dollar is bleeding. Reason number 1, the tariff trap. In 2025, the U.S. unveiled the highest tariffs in decades. President Trump picked a fight with the Federal Reserve and threatened to fire Chairman Jerome Powell, and the U.S. had its longest government shutdown ever. When a government introduces policies that are this unpredictable, foreign investors get scared. They start asking a question that used to be unthinkable. Should I keep trusting my money in U.S. assets? The rapid depreciation in early 2025 came due to erratic trade policies that undermined trust in U.S. assets and ultimately in the currency's safe haven character. The dollar has always been considered the safe haven, where the whole world runs when things get scary. When that faith starts to crack, even a little, the ripple effects are enormous. Reason number 2, the Fed is cutting rates. Because rate differentials are a fundamental driver of currency strength, the more that U.S. interest rates fall to match the levels of its peers, the more likely it is that the dollar will weaken. Think of it like this. When U.S. interest rates were high, foreign investors loved buying U.S. Treasury bonds. Good returns, safe country. But when the Fed starts cutting rates, like they did in December 2025, lowering to a target range of 3.50%, 3.75%, those bonds become less attractive. The dollar's strongest fuel is yield. When U.S. yields decline compared to Europe, the UK, or even Japan, the USD forfeits a portion of its carry benefit. Less demand for dollars, worst, weaker dollar, basic supply and demand. Except the consequences for your grocery bill, rent, and retirement savings are anything but basic. Reason number 3, the debt monster nobody talks about. The U.S. national debt has crossed $36 trillion. Let me give you a visual. If you spent $1 million every single day since the year 0, the birth of Jesus, you still wouldn't have spent $1 trillion. The U.S. owes 36 of those. The U.S. fiscal picture is a recurring 2026 headline risk because it affects term premium, treasury issuance, and the political debate around debt sustainability. The CBO's long-run outlook highlights large projected deficits in the coming years. When global markets start to doubt whether America can manage its own debt, they start selling U.S. bonds. When they sell bonds, yields spike. And when yields spike alongside a weakening dollar, that's the dangerous combo economists call a confidence crisis. This is the one that Wall Street doesn't want on your radar. It's called de-dollarization, and it is happening right now in real time. The dollar's share in official foreign currency reserves has declined from 90% in 1960 to 45% in 2023. Its share in the bond market has dropped from earlier 50% to 30% in 2024. And its dominance is declining in the commodity market, especially in energy. BRICS, a coalition comprising Brazil, Russia, India, China, South Africa, Indonesia, Iran, the UAE, Egypt, and Ethiopia, has commenced de-dollarization. By using local currencies facilitated by the BRICS pay system instead of the US-controlled SWIFT. 97% of trade in 2025 among the Shanghai Cooperation Organization nations, which has 10 full members including India, Russia, China, Iran, and Pakistan, was conducted in non-dollar currencies. That is a staggering shift. Countries that used to need dollars to trade with each other are now bypassing the dollar entirely. Every time that happens, demand for US dollars falls, and when demand falls, the value falls. Reason par in 5, gold is screaming a warning. When smart money, central banks, sovereign wealth funds, the people who manage trillions, starts buying gold instead of holding dollars, that is a signal. And right now, the share of gold in foreign exchange reserves among emerging market central banks has more than doubled over the past decade, from 4% to 9%, with China, Russia, and Turkey being the largest buyers. Gold prices are forecast to climb toward $4,000 per ounce by mid-2026. When gold goes up, it's usually because real money is losing faith in paper money. This isn't a coincidence. This is a coordinated global repositioning away from dollar dependency. What this means for your everyday life. Okay, so the dollar is weakening. Why should you care if you're just a regular person trying to pay your bills? Here's why it hits you directly, in the wallet, every single day. Inflation stays sticky. A weaker dollar means imports cost more. The U.S. imports hundreds of billions in electronics, clothing, food ingredients, and raw materials. Those higher costs get passed to you at the checkout line. Your savings are eroding. If inflation runs at 3–4% and your savings account pays 1%, you're losing purchasing power every year. You're not saving, you're slowly drowning while standing still. Your retirement is at risk. If your 401k is heavily weighted in US dollar-denominated assets and the dollar keeps weakening against global currencies, your future purchasing power shrinks. What feels like gains in dollar terms may actually be losses in real terms. Imported goods cost more. Your iPhone, your car, your TV, your medication. A massive percentage of what Americans consume comes from abroad. A weaker dollar makes all of it more expensive. This is not doomsday talk. This is household economics, and the average family will feel this whether or not they ever watch a finance video. If this is opening your eyes right now, please take 2 seconds and hit that share button. Send this to a friend, a family member, your group chat. Knowledge about money is the most valuable thing you can give someone. And we're just getting started, because in the next few minutes, I'm going to give you the actual solutions and the moves you can make right now at any income level to protect yourself from what's coming. Don't go anywhere. The Money Science or Cure, your complete protection playbook. This is what Money Science AR is all about. Not panic, not doom. Science-based solutions. Here are the moves, from beginner to advanced. Cure number 1, diversify beyond the dollar beginner level. The simplest thing you can do today is stop keeping 100% of your financial life in US dollar-denominated assets. How? International index funds. Funds like Vanguard's VXUS or iShares iExis give you exposure to thousands of global companies priced in euros, yen, pounds, Swiss francs, and more. With the potential for the dollar to drop a little further, potentially pulling local currencies higher, and high yields relative to the last 15 years, introducing some non-USD international bonds can make sense today. Even Charles Schwab, one of the most mainstream financial institutions in America, is now openly recommending this. Start small. Even shifting 15–20% of your portfolio into international funds changes your exposure dramatically. You don't need to be rich, you need to be intentional. Real assets don't lose value when a currency weakens. They often gain value because they're priced in that weakening currency. Gold and silver, the oldest inflation hedge in human history. You don't need to buy bars. You can buy gold ETFs like GLD or physical gold through trusted dealers. The growing demand for gold, seen as an alternative to heavily indebted fiat currencies, has driven a current bull market in gold, with prices forecast to climb toward $4,000 per ounce by mid-2026. Real estate. Property holds value in real terms even when the dollar weakens. If you can own your home or an investment property, you're holding an asset that tends to rise in dollar terms as the dollar weakens. The house doesn't change. The dollar measuring it just gets smaller. Commodities, oil, copper, agricultural goods. These are priced globally and tend to rise as the dollar falls. Commodity ETFs give you exposure without needing to store barrels of oil in your garage. Here's a mindset shift most Americans never make. Start thinking like an international investor. Countries like Russia, India, China, Brazil, and Malaysia are seeking to set up trade channels using currencies other than the dollar. Why? Because they understand that monetary power is shifting. You can piggyback on that shift. Look at emerging market funds. As BRICS nations grow stronger and trade more in local currencies, their economies and stock markets benefit. Funds like EEM, iShares MSCI Emerging Markets, give you exposure to this global shift. Consider foreign currency exposure. Some financial platforms allow you to hold small amounts of euros, Swiss francs, or Singapore dollars. In a world where the dollar is losing ground, holding a basket of stronger currencies is pure monetary science. We'd be doing you a disservice if we didn't address this. Bitcoin was literally designed as a hedge against fiat currency debasement. Its supply is hard-capped at 21 million. The dollar's supply? The Fed can print as much as it wants. Now, we're not saying put your life savings in Bitcoin. This is high risk. But a 2–5% allocation to Bitcoin as a small hedge against dollar debasement is increasingly being discussed even in mainstream financial circles. The core logic is simple. If governments keep printing money and debasing fiat currencies, hard assets with fixed supply should appreciate in real terms. Do your research. Understand the risk. But don't dismiss it because it sounds unconventional. Gold sounded unconventional to people who'd never owned it too. This is the long game, and it's becoming more accessible than ever. Freelance globally. Platforms like Upwork, Fiverr, and TopTal let you get paid in foreign currencies. If the dollar weakens against the euro and you have a European client, you actually benefit from the exchange. Start a digital business with global customers. If you earn revenue in euros, pounds, or other currencies and spend in dollars, a weakening dollar makes you richer, not poorer. Invest in foreign dividend stocks. Companies in Switzerland, Germany, Singapore, and Australia pay dividends in their local currencies. A weakening dollar means those dividend payments, when converted, are worth more. This is what the wealthy already do. They don't keep all their eggs in one currency basket. Now you can do the same, from your laptop. Here's the hardest truth. None of these tools will work if you don't understand money. The dollar is weakening, but for people who are financially educated, this is actually an opportunity. The weakening of the USD also reflects cyclical factors, and there is still a good chance that erratic policymaking recedes ahead of the 2026 midterm elections. This might not be a permanent collapse. It could be a temporary window to reposition. Smart investors profit on both sides of currency moves. Read about monetary policy. Understand inflation. Learn what a real return means. Learn what purchasing power parity is. Follow reliable financial sources. Take one course, read one book, watch one trusted channel, like Money Science AR, every single week. Knowledge is the only asset that can never be inflated away. Let's bring it all together. The dollar is not disappearing overnight. The dollar remains the world's primary trading currency and reserve anchor, and that structural demand rarely fades quickly. As of 2025, the US dollar is still dominant in the foreign exchange market at 88%, trade invoicing at 40%, and cross-border liabilities at 48%. But its dominance is declining, slowly, structurally, and now, with more speed than at any point in decades. And the people who refuse to acknowledge that, who just keep doing what they've always done, who keep their entire financial life in dollars and hope for the best, those are the people who will feel this the hardest. You don't have to be a billionaire to protect yourself. You need to be aware. You need to act. You need to use the tools that exist right now. International diversification, real assets, multiple income streams, and above all, financial education. That is the Money Science AR way, not panic, not fear, science, strategy, solutions. If this video gave you value, if it made you think differently about your money, then do something about it right now. Hit that like button. It takes 1 second and it tells YouTube to share this with more people who need to hear it. Subscribe to Money Science AR so you never miss a breakdown like this. And share this video. Send it to your friends, your family, put it in your story. Because in a world where they profit from your financial ignorance, the most powerful thing you can do is learn and share. I'll see you in the next one. Stay sharp, stay smart. This is Money Science ARs and we're just getting started.